Hello, good evening, everybody. Welcome. Also, welcome to our Facebook audiences as well. I hope you all had a wonderful day. Thank you for joining our webinar tonight. So, tonight we are going to be discussing where to find the money, how to fund your investment deals. So, before we start, just a few ground rules. If you have questions throughout the presentation, please type it in the chat and we will get to them in the order it was received at the end. So, stick around for that. So yeah, without further ado, let's go ahead and get started. Allow me to introduce the man that made all of this possible, Mr. Nhan Lam. Yan, are you there?
Yes, I am. Thank you, Vaughn. Can you hear me?
Yes, loud and clear.
All right, fantastic. Well, thank you so much for the kind and warm introduction. And ladies and gentlemen, today is August the 18th. And usually we'll be having this event on the second Wednesday of the month, but this month is special. We had to adjust our calendar, and it is on the third Wednesday every month. But just make a note, it's usually on the second Wednesday of every month. And tonight, this is one of my favorite topics because most people who have long aspired to do real estate investing chooses not to because they're afraid of not being able to fund their deals, be able to find the money. All right. And as my PowerPoint presentation pulls up here, I want to share with you why people feel find that that's a challenge. A lot of times they limit their own mindset to where they are positioned as where they are financially. But in real estate investing, it has nothing to do with where you're financially. It has nothing to do with where you are in your life. It has everything to do with your ability to raise money. Okay, so let me see if I can pull up this presentation here. All right. And here we are, okay? All right, so how to find the money for your deals, okay? Let's go through the slides real quick. And again, as you go through this presentation, you have any questions, please feel free to put into the chat, and then we'll go from there. So let's go through the mindset right now. What is the mindset of a sophisticated investor? Now, what does that word sophisticated mean? So, basically it's the opposite of amateur, okay? So in a non-amateur investor's mind, what is a good cash on cash return on investment from a percentage wise in real estate? All right. Is it 5% annualized yield? If that was you right now in a savings account, that's genius. Because right now, most people, no matter how much money they have in the bank, if they put it in the savings account or the money market account, they're lucky to get 0.5% annualized. Okay. So is 5% good in this marketplace? Probably so. But that's not what we're shooting for. How about 10%? Is 10% pretty good? Well, if you get a certificate deposit from your bank, I've seen as high as the highest it goes is probably 1.5% annualized, and you can't touch your money for a certain period of time 1 year, 2 years, 3 years, or 5 years. All right. So is 10% a good deal compared to that? Probably so. But is that what sophisticated investors are aiming for? The answer is no. How about a ridiculous number of 25%? I remember my very first credit card in college. The interest rate was 25%. It was ridiculous that they were making that kind of money off of me as a consumer if I did not pay my balance in full. But even if you were the bank and getting 25%, that's a pretty good return. But is that what we're shooting for as a sophisticated investor? The answer is no. Your goal is to get an infinite return on investment. What does that mean? That means you have the ability to make money without using any of your own. I'll say that one more time. You have the ability to make money without the constraint or requirement of using any of your own. Okay. And so that's the mindset of a sophisticated investor to be able to do things and get it with infinite returns. Or how are they able to accomplish this specifically in real estate when you have to buy them, hold them, fix them, flip them, or whatnot? Well, the answer is OPM. All right. It stands for other people's money. If you have the ability to find and access other people's money, your potential is limitless. Okay. So let's go on to the next slide here. All right. Well, what kind of OPM and types of OPM are there available to real estate investors? Well, there are a number of things we'll go through tonight. All right. And we also have a special guest speaker later on that's going to talk about one of the best and easiest way to raise the majority of the money that you'll be needing for your real estate deals. Okay. But first and foremost, we got private investors, we got equity partners, we got conventional loans, seller financing, your own personal assets and accessible capital, your own cash, obviously, but we try to not use that as much as possible. And then, of course, there's hard money. Okay. So what is a private investor? A private investor are those who have access to cash, either themselves or their own credit. that you know, that you like, and you trust, people you know well. This funding can be used to make up the difference for required funding after a hard money lender, which we'll be talking about later on. Okay, where does the money come from? It comes from the cash and savings or home equity or retirement accounts via loans from the people you know. The pros for accessing money through private investors is that it's cash equivalent and you can treat it as such. It can be available very, very fast. And you don't need a credit and appraisal check. Obviously, your friend or family who's going to be borrowing money from will not be doing a credit check on you. Okay, and it's pretty easy to negotiate. I mean, if they normally get, let's say they have $100,000 accessible cash right now, and they normally only get 0.5% in the bank, and you're offering them 6%. All right. Well, 6 divided by 0.5% is a 12 multiple of 12 factor fold that they're increasing the return by simply loaning it to you versus keeping their money in their savings account. Okay. Now the cons are that private investors may be weary if they don't have a lien on the property, and that depends on how much they trust you and what kind of documentation and contractual agreements you set up between you and that private investor. All right, and then and you want to. And then also you need to sell the deal in order for them to feel secured. Okay, so going on equity partners. Okay, now these are people with access to a lot of cash, and they possibly can fund you the deal completely without you having to cough up any money or raising any money and paying annual return. All right. Again, these are cash for people that know, like, and trust you. The pros are that they are cash equivalent, they can be available fast, and there's no credit or appraisal, obviously. And they can generally fund the entire project, which includes acquisition, renovation, holding costs, and you don't need to pay them a monthly interest payments like you do with a hard money lender over time until the deal actually closes. All right. So let's say right now you buy a piece of property for $100,000 and the renovation costs $50,000. For number six, let's say we're using those numbers that without the closing costs. Okay. So you need to raise $150,000. An equity partner comes in and gives you $150,000 to do this project. You work the project, you manage the project, you lead the project to success, and also you manage the resale. And let's say you sell it for $200,000 and some change. Okay. Well, once that money is all done, you get to decide how much profit that you give back to your equity partner. So let's say your profit margin is $50,000. Now you can choose to show them to offer a percentage split based on that deal because you didn't pay them any kind of percentage or annual percentage of interest, and instead you're giving them a percentage of the profit. So if it's a 50-50 split and the profit was $50,000, you split $25,000 with the equity partner, and you pay $25,000 yourself, but you didn't use any of your money. So in that situation there, you made $25,000 without any of your money, which equals and equates to an infinite return on investment because you didn't use any of your money. All right. The cons of this is that the overall project cost would be more to you because they're going to, the equity partners will want a percent profit sharing instead of just a straight annual interest yield. If you were to get them to loan you $150,000 of cash at an annual percentage rate, you actually would make more money, but then you have to cough up more money to be able to pay the interest charges on a monthly basis. All right. So there's pros and cons in those types of situations. All right. And you decide what's best for you based on that situation. Next kind of ability to access money is conventional loans. All right. You can do it through via a commercial loan or via a residential loan, depending on what you qualify for at your bank. All right. A conventional loan is simply a mortgage from a traditional bank. It could be a community bank. It could be a large bank like Bank of America, Citibank, or it could be a small bank locally up here in DMV. It could be Eagle Bank, Main Street Bank. It could be a number of small banks. All right. Here's the pro. The pros is that these loans generally are very cheap, much cheaper than hard money, and much cheaper than private investors. But the cons are that you're depending on the bank, and they sometimes may not fund if the condition of the property is bad. If it's too bad with structural damage with a lot of mold, they may not want to finance that. They also be checking your credit and also getting an appraisal. That's required by banks. All right. And the loans take longer to approve. You can't close fast. All right. And it doesn't make your offer as strong because if you're going to find a good deal with a motivated seller like you normally would, if they see that you need 4 to 5 weeks to close on the property, they may not want to go with you because they're going to wait too long for you to qualify for a mortgage. They'd rather go with someone with accessible cash right then and there so they can close in 2 weeks or less. All right. But regardless, if the seller has time to wait, you may want to approach a bank and try to get a loan from there and kind of bite the bullet with the time frame and just to get a cheaper loan. Okay, so moving on to the next one is seller financing. Now, this is one of my favorites, okay? Because if a seller currently has equity in the property, or maybe they own it free and clear, and all you want to do is fix and flip it, you can easily negotiate a simple purchase price to where you may give them something now, or you may give them something, or you may not give them something at all. All right, but you want to be able to control the property, and then the seller controls the note to the property via seller financing. So basically, they're like the bank. So let's say right now they're selling the property for $100,000. You don't want to spend any money right now on your own. Okay, so you finance it for $100,000, not through a bank, but instead through the seller, and you two negotiate the interest rate that they'll be getting on a monthly basis. All right, until your note is paid off, and you guys can work that out on how that is arranged. And then you raise the money through a private investor with all the renovation costs if you're going to fix and flip it, and then you can go ahead and once it's all done, you sell the property. You now can pay off the seller finance loan. You now can also pay off the private investor loan, and whatever's left over after all that expenses are paid is now your profit. And once again, you didn't qualify for a mortgage. You just simply used the seller. They didn't do a credit check. They didn't do an appraisal, and you just worked it out to where you can close on the deal via seller financing. Here's some pros, okay? It's generally cheaper than hard money and private investors. Usually there is no credit checks, and it can easily be negotiated if you have a seller who's very easy to work with. The cons are, it's very hard to find a seller who's willing to do this. It is true, because a lot of them just want their money now and leave. All right, and they're not educated in the form of how to hold a personal note on the actual property. All right. Also, the down payment renovation costs will need to be funded from elsewhere. In other words, the seller's not going to give you money to fix the house. All right. You got to raise that money elsewhere. It could be a private investor. It could be a second mortgage. It could be a bridge loan. It could be a number of things. All right. So you have to think of some creative finance to be able to get that accomplished. And we've done this a couple of times in our life to great satisfaction and great success, to where we were able to save money on financing, but at the same time, the seller was able to not only get the money that was due to them, but they also got some interest on their loan as well throughout my holding period. Okay, and the next thing is the actual hard money. Okay, now what is hard money? First of all, it sounds like an oxymoron, because hard money is not hard to get. The reason why it's called hard money is because this is money that's backed by a hard asset. Hard asset specifically meaning real estate. Okay, so to go through what hard money is, we have the number one hard money lender in the DMV area. I've known them for the past decade, and they've done so many great things for us personally in the DMV area. And there's a reason why they're number one, is because their team has done fix and flips, rentals, and different types of investments as well. So they know this market very well to be able to not only finance deals for investors and borrowers, but also give them sound advice on ARV, renovation costs, to make sure things make sense for them and make sure that everyone makes money. So I'm going to turn this over to my good friend, Connor Riley from Washington Capital. Connor, go ahead.
I appreciate it, Jan. Thank you very much, guys. Just a little bit about us as we're pulling up our PowerPoint. I'm going to breeze through some of these slides simply because Jan's already covered a lot of these topics. I mean, this is the number one topic inside of real estate investing, is whose money do you use? The number one goal is never to use your own, because as you said, you can make an infinite amount on there. WCP, as Jan said, we're kind of a 600-pound gorilla in this marketplace. We're the largest lender inside of the Mid-Atlantic. Since 2012, we financed nearly 3,000 loans with just about $2 billion in capital being deployed. At that time, that was pretty much just between DC, Maryland, Virginia. And as of now, from the past about 6 months or so, we can lend up and down the East Coast, Pennsylvania, New Jersey, Maryland, DC, Virginia, the Carolinas, Georgia, Florida, and then we'll throw Texas in there as well. So we're comfortable lending on projects from any of those states to help you guys in your real estate investing career. Now, as Jan was saying, well, one, I'm going to skip through some of these slides. So what is hard money and how do you get into it? Hard money is an asset-backed loan. So first and foremost, we care about the property itself and what is the project scope. Additionally, we do want to see some funds into that. Now, how you get that money is really up to you as long as it is legal. So you'll have personal cash and credit. You can use credit cards, bank loans, HELOCs. You can be raising the capital as a second trust, as Jan was going into. And what we do in terms of partnering up or whatever it might be is we lend up to 80% of the total project costs. So let me find this slide here. Here we go. So fix and flip loan. This is for when you're looking to buy the property and sell it. So we lend anywhere from 80 to 90% of the total project costs. What that means is I take the purchase price plus the construction costs, and we'll fund anywhere from 80 to 90% of that value. Now, that difference of the 10 or 20% is when you're going out and you're raising that money to apply as the down payment. Now, as interest rates go, Jan was saying that banks are generally cheaper than the hard money. That is absolutely true. However, we have helped to drive down the hard money rates of this area down to an interest rate of about 6.99% is where we can start at. Now, inside of our total loan amount of 80 to 90% of the total project cost, we fund 100% of the renovation costs, and we hold that back at closing and we release it in what's called a reimbursement style draw process. So all we do there is that you would be first in on construction, and we release funds based on what you've completed on site at the project. So now, when you're raising money, one of the things that you want to consider is to make sure that you have enough money not only raised for the down payment of the property, but also enough for interest payments to start and for construction draws. So let's say that the down payment and closing cost is $60,000. You'd likely want to go raise $75,000. So that way you're not coming out of your pocket to pay the contractor to start work. That's other people's money. Additionally, from fix and flip loans, we also offer acquisition only loans. So this would be anywhere from 75 to 80% of the purchase price. Additionally, we can help with refinancing. This would be up to 75% of the as-is value of the property. So in a refinance, you already own the property and you're looking to put new debt on it, be it for finishing the project in terms of new construction, or just looking to get out of a higher interest rate or a lender that's looking to get paid back. Following refinance, we also have cash out refinance loans in which we can take the equity that you have built into a project and we can give you that money at closing. So this would go up to 65% of the as-is value, up to about $10 million. Again, as you can see, rates are at 6.99%. And let's see here, bridge loans. So these are for these generally larger projects that you need to acquire quickly in order to get planned and permitted, or wait until you have bank financing. So we do this for some clients that are looking to acquire like tract projects or 60-unit multifamily buildings that need to have a quick close, but they want to do the construction financing with a bank because banks are at 3%. Completely understandable. We can offer the ability to close on those projects so that they are not lost. We also offer new construction loans. So this would go up to 75% of the total project cost. And lastly, well, this is transactional funding. So this is not lastly, I apologize. Transactional funding is when a wholesaler is looking for 100% of the purchase price. So you're not exactly assigning the deal. In a transactional funding project, you are closing on the deal and turning around the same day and selling it to somebody else. We offer the funds to you to cover the entire purchase price and the closing costs while you sell to somebody else. Additionally, we also offer 30-year rental loans in which people are turning these fix and flip projects into long-term buy and holds. We can help offer 30-year notes on that, be it 30-year fixed rates or interest only for a set number of years. Since Jan has covered a lot of the things that I would have gone over in this presentation, I'm going to kick things over to him. I'll put up on the screen here my contact information. I am happy to help underwrite any single deal that anyone is looking at. As Nhan was mentioning, one of the things that we've done to help differentiate ourselves is that we want to make sure that you're getting into a good project, and we do all of our underwriting up front. So you're going to send us a project of, here's the address, purchase, construction costs, and we're going to take a look at it and see what we would be comfortable lending, and if the ARV even makes sense. So use your lender as a second set of eyes, because we want to see you succeed. We want a long-term relationship. That's the only way we've been able to stick around. As you can see here, my number is 860-371-7700. That's my direct cell phone. Feel free to shoot me a text whenever you like. My email address is on there, and I'll stick around, and I can put my information in this chat as well. But I'm more than happy to help out in any way possible, whether that's trying to structure how to raise money, how to structure second trust if someone wants to be recorded, whatever it may be. If it's not something I know, there's likely somebody that I know that can help out. And Jason, we will touch on that during the question period, absolutely. But I'll let Nhan continue for now.
All right. I appreciate it, Connor. Thank you very much. And you know what? If you had some same material as my presentation, that means we're all on the same page, right? Good
Absolutely.
stuff.
Yep.
Good. All right, good stuff, guys. So let's continue on real quick. And Connor actually touched on personal equity as well. I want to touch base real quick on that aspect too, because most people underestimate how much they're worth. I mean, Bill Gates once told me, or not told me personally, but once said that most people undervalue how much they are truly worth. So the lesson there is that you should never undervalue how much your assets are worth. Okay, so you're generally worth more than you think. So think about it. Everyone can count the cash in the bank and the cash in the pocketbook, but have you thought about your home equity? How much equity is your home right now, and how much is your mortgage? Is there a spread in between to where you can possibly get a home equity loan? Can you possibly get a line of credit from the bank, whether it be a personal line of credit or a business line of credit or even a home equity line of credit? Most people who have been working for the last so many years on their full-time job has probably contributed to some kind of 401k or retirement plan. Do you have the ability to get a loan from that retirement plan without the penalty? Loans are not withdrawals, and it's not a withdrawal event. So there are no penalties on there. And in fact, when you get a loan from your own retirement account, you pay back interest to yourself anyways, and it is taxed, it's still, that interest is tax deferred. Okay. So a lot of different ways to get access to money. Okay. So what are the pros of your personal equity? Well, guess what? One of the pros are it's very easy to negotiate with yourself. Well, how much are you willing to loan yourself? Okay. So you got to find out how much you have access to, and you can figure out how much you can use towards your business. The cons is that your return on investment does go down if you use your own equity. But if you're borrowing from your own equity, that's a whole different story. If you're borrowing $100,000 from a home equity line of credit at 3%, and you're using that $100,000 line of credit to purchase a piece of real estate and to fix it up and make a profit, that's a pretty good return. You're going to pay that 3%, but you're going to make a profit on the back end that's much more than 3%. Okay. So personal equity. So the important skills and values that you want to have as to be a successful investor is you want to have the ability to assess value. What I mean by that is that when you see a piece of property, you got to be able to visualize what it can be. And once you can visualize what it can be, how much should it be worth in that particular neighborhood? Okay. Assess the value. You got to also have the ability to raise capital. If you don't have the ability to raise capital or not willing to raise capital, then this business is not for you. You got to have the ability to raise money and not be shy to ask for money. We're not asking you to beg for money. We're asking you to raise capital to help people who are getting a very subpar return and give them an opportunity to earn a much higher return by working with you through real estate instead of keeping their money and 0.5% interest in their savings account. You're helping and serving the community by giving them an opportunity to make much more. And at the same time, your win-win relationship allows you to use that capital to invest in real estate for you to get a return for yourself. Okay, you gotta have the ability to negotiate. All right, negotiate not only the deal, but also negotiate with your private investors. What kind of deals can you cut that will make it profitable for both you and for them? You got to have the ability to build a win-win relationship. You can't do a lose-win relationship where you're the only winning and the other person always losing. Because if that happens, that person will never want to work with you again, and you lose reputation, lose face, and they'll spread the word. Negative news travels faster than positive news, and you'll never be able to do work again in that small circle of friends. All right. And last but not least is generosity. I'm sorry, your integrity. All right. Your integrity means doing the right thing, even though it's not the easiest thing to do. And then last but not least, your generosity. What I mean by this is that there's been some times to where we had deals that did well, and sometimes the deals that didn't do too well. All right. For the deals that we did do well, we didn't mind throwing a bonus to our investors. So that way they're encouraged to come back to us to do it again. All right. So generosity is very good, because the more you give out of the right kindness of your heart, the more comes back to you in the form of opportunity and other blessings. Okay. All right, so let's go through an actual example. We've talked about the theory, but let's talk about how you can apply it into practical use. All right, here's a deal that we did in Southeast DC not too long ago. We purchased it for $145,000, and the assessment for the renovation was $80,000. It is an end-unit semi-detached building in Southeast DC. It was built in the 1940s, and it was in desperate need of repair. The previous owners were hoarders. As you can see, there's a picture of the living room. They had a whole bunch of junk there that later had to be removed. All right. So here's the actual numbers on how everything worked. So if you take a look at the renovation, was $80,000. All right. So when we got our loan, as Connor mentioned, that they will fund 100% of the renovation cost, but they're going to hold back that money until you hit certain milestones along the way. All right. So there was a construction escrow draw of $80,000 that was held back at closing. So you look at the HUD settlement statement. This is the statement that you look at once you buy a piece of property. You'll see that the amount due at the bottom, all right, cash due at closing was about $65,000. All right. Now, if you hold a piece of property for 6 months, this includes interest on your loan, real estate taxes, utilities, real estate, and I'm sorry, insurance as well, and other things you pay on a monthly or regular basis. For 6 months, was roughly $15,000. So the total amount needed was $80,000. All right. In addition to our hard money loan. Now, we got the hard money loan, 80% loan to cost, but we need to raise $80,000 as a down payment. Okay, so where should this money come from? All right. Well, the money should come from your ability to raise money from your private investors, and that's exactly what we did. We raised $80,000 from our private investor pool and gave them a decent return on investment. So once we finished the project, you'll see here that in the spring of 2019, we were able to sell the house at $350,000, less $10,000 concession, so the net was $340,000. All right. So concessions is simply the buyer's the buyer's request for us to help them with closing costs. So if we're helping them with closing costs, then that's less money to us as a net. Okay. So once all the loans have been paid off, all right, once the hard money loan has been paid off, we were left with $145,000 and some change. All right. We had to repay back our private investors of $80,000. We paid them 10% over that 6 months, which is roughly $4,000. And whatever was left after that, guess what? It was $61,000 and some change. Okay. So if you take a look at that, what is the percent return on investment on this profit that you made on this deal? Well, guess what? You guessed it. It was infinite, because I didn't use any of my money. I used the hard money lender's money, and I used my private investors' money, and I managed the project to completion and managed the resale with my agent. I was able to make $61,000 with none of my own money. Now, that was just one deal. All right. Can you imagine doing 2 deals a year, 3 deals a year, 4 deals a year, 5 deals a year? I mean, the sky's the limit if you have the ability to raise money. Okay. So how long did it take for us to realize this profit? It took 6 months. All right. So you take the numbers and divide by 6 months. We made $10,000 and some change per month doing this deal. And one deal doesn't take a lot of time. All right. You can do this on a very part-time basis and still keep your full-time job. As I mentioned earlier, how many deals can you do simultaneously? All right. What are your limits? All right. Well, if you have the ability to raise capital and the ability to use Washington Capital and have a good pool of private investors in your network, then the possibilities are limitless. You can do 2 deals simultaneously, 3 deals simultaneously, 4 deals simultaneously, and just imagine how much profit you can make by doing more deals simultaneously and it not be constrained to how much resources that you personally have. All right. So now, guys, we are in the part right now to where we're gonna go through some questions. So I'm actually going to turn it over to Yvonne, who actually introduced me to earlier to be able to go through these questions. And if you have a question directed to me, please mention my name. And if you have a question directed to Connor, please direct to their name. So Yvonne, I'll turn it over to you.
Thank you so much, Jan. Right. So let me look at the questions. First questions. First question. It's from Jason Harris. I believe this is for Connor. Can you please elaborate on the 30-year rental loan?
Yeah, absolutely. Um, Jason, if you wouldn't mind putting in the chat a little bit more exactly what you're looking for there in terms of leverage or rates, I'll just kind of go into high level things, or if it's how do 30-year rentals work. So in terms of leverage and rates, we can go up to 80% of the LTV, meaning the as is value, or 80% of the purchase price, with rates as low as 3.875. However, can't exactly combine those things. You can't get the best of both worlds. You can't get the highest leverage with the lowest rates. For example, how we actually calculate what we're able to offer in terms of leverage and rates is based on what's called the DSCR, the debt service coverage ratio. At the end of the day, all this means is how many times does your monthly income from the rental property cover your monthly debt. Now, as an investor, you want to be 1% or higher. There are other lenders that are requiring 1.2 or 1.3. We are requiring 1.0 as best practice because there are some lenders that require 0.75 as a DSCR, meaning they are willing to lend to you on a property where your monthly income does not cover your full debt. To me, that is a very, very bad practice. That is not something that I would want to get into because I want to make sure that you're going to be making money on your rental property now and in the future for a very long time. So, Jason, as I mentioned, LTV goes up to 80% with rates as low as 3.875. To be honest, where we're normally seeing things is about 70 to 75%, with probably a rate 4 to 5%. Now, the reason that someone would use a hard money lender as a 30-year rental loan versus a bank is because Fannie and Freddie, the major organizations are beginning to limit the number of investment properties that you can have in your personal name. That can be only up to 10. So if you're looking to truly scale, you need to find other ways to get those rental properties into your portfolio. We can do individual rental loans or we can do portfolio rental loans. Yes, there will be prepayment penalty here. We have many different options that impact the rate. We have 10-year prepayment options that lowers your rate, and the shortest would be a 3-2-1 step down, it's called, meaning in year one of the loan, it's 3% if you pay off. In year two, it's 2%. In year three, it's 1%. Now, at 4 years and 1 day, there is no longer a prepayment penalty. So what I'm currently doing with a couple clients is I am working on interest-only loans. We're doing a 10-year interest-only loan with a 20-year amortization schedule followed by that with a 3-year prepayment penalty. So for 10 years, they're only paying the interest only, and after 3 to 5 years, they will likely sell. Largest multifamily. Those are different underwritings. And Jason, if you want to talk about this, I'm more on a one-on-one situation, more than happy to do that. We are doing loans up to $10 million, 5 units to probably about 60 is what we're looking at right now. So just shoot me over an email. We'll do that right now. I'm actually running a couple test loans on that to make sure that the product is up to speed into something that I'm willing to put out there because this is not something we have marketed yet. So you guys are hearing first. One other thing I did want to bring up in this type of conversation, Jan, I'm not sure if we cover this one, is partnering up. A lot of times, early on, real estate investors are little bit low on liquidity, but everybody knows each other. Real estate is about networking. So if you have 20K and you know somebody else has 20K, put it together. Now you have 40 grand. That can get you into a property, especially inclusive of you raising other funds. So that's another way. These events right here, every one of these attendees, get their information, talk with each other. This is where you network and you find deals together, and you get in and you get your experience together as a team. Depending on the location of the storage facility, we would be interested. Because I am what's called a direct lender, we have our own fund. We get to make our decisions. So my CEO, he started this company based on the fact that he wasn't seeing money flowing to the real estate investors after 2008 from the banks is the same way it should have. So we're still willing to make some decisions based on things that wouldn't generally fit our underwriting criteria because we know the market so well. So absolutely, we like storage facilities right now. Warehouses we're a fan of. I do not like churches. I'll be honest with you. Anything that's a religious facility is not anything that we would like to put our name on. Trying to think what other questions might be out there. Anything about rentals or fix and flips? Even our own employees, they go out and they raise money. My partner here that I run my team with, he got a loan from us, from WCP, and he also goes out and he raises money from friends and family to do deals. He's doing a 3-unit conversion on Girard Street right now. So this isn't just a way to start into real estate. This is a long-standing practice. No, we will not be doing mobile parks at this time. Keep them coming, though. I love this.
All right, Jason. Hey, I think I think we got a 10-question limit for you, buddy. But feel free to reach out to us. We have our contact information, and Connor, we're more than happy to work with you one-on-one. And you sound pretty excited, and we love working with excited people. So hopefully we can do a deal together in the very near future. Our goal is to do deals with our group. Yes, we provide training to kind of give you some value and content and give us a background of us. But our whole goal is to be able to do deals with you so we can have a win-win profit joint venture together. All right. That's the 11th question. All right. Anyone else may have a question? All right. So I guess we are good for now. So guys, next month, I'm super. Actually, I want to give you guys a quick announcement. Since COVID started, we used to have a live event out in Gainesville, Virginia. We've been doing things virtually since COVID started, and we will continue to go through virtual sessions for the rest of this year, especially with all this crazy stuff going on with different places. But we do want to go back live as soon as possible. And our target right now is not definite yet. Our target goal to getting back live at a real event is in January of 2022. All right. So you live in Gainesville, Haymarket, Manassas, Centerville, Chantilly, or anywhere near, or even down to Fredericksburg or Richmond or Maryland or wherever you want. I've had people coming from all over the country just to be able to attend our events live if we didn't have it virtual. Okay. So I'm looking forward to announcing an official date once we have it all set in stone, and looking forward to shaking hands again, bumping elbows, and get a chance to network. I see you guys are very eager to network right now because you're exchanging contact information here in the chat tool. But we love networking and be able to build a community of real estate investors that can work with one another. Okay. So now, yes, Bristol as well. Bristol. Can't forget Bristol. Okay. Yeah. Okay. Columbia. Go Columbia.
Yeah, and I have one more thing.
Yes, please.
Before we hop off here. Obviously, the hardest part about all of this is probably finding deals, not just money. Money's plentiful out there, no matter what anyone says. But one thing that we are able to offer that a lot of other lenders are not is relationship with wholesalers. So we have an off-market website called Off Market Deals HQ, where our goal is to try and get our clients into these off-market deals. So anyone that's here, shoot me over an email and I will get you onto our list for that. And we'll get you and Nhan looking at these properties together so that everyone can make an informed decision on if they want to pull the trigger on it. And oftentimes, because of our relationship with the wholesalers, we can push deals a certain way.
All right, good stuff. I can't forget my friends in Charles County in Maryland, Echo Creek, Maryland. Yes, we can't forget you guys. So I appreciate we're acknowledging you guys, and anywhere else in the DMV area and also nationwide. There was a question about the events if they are free. Our webinars are always free. However, when we go to the live events, we've always had live events that are free. Even though when we provide beverages, food, and drinks, it's still always free. And the reason why we invest in that is to be able to reach out and have an outreach program for the community to join with us and build a relationship with everyone. Because I started like most of everyone where I didn't know how to do this, and I went to an event just like this to learn from others and rub shoulders with those who are already doing it to become successful. Okay, so you never know who's going to be the next success story until they actually come into the room and then see how serious they are with getting the information, applying it, and going from there. So yes, the events that we will hold live in person will be free, located in Gainesville, Virginia. Okay, so with that, guys, next month, I'm very excited. I know Jason had a question about multifamily. We actually will be talking about how to invest in multifamily buildings next month. All right. And I'm not talking about, small units. I'm talking about hundreds of units in one deal. And we personally invested capital in these deals with some of our folks who are doing this very well. We look at some deals as well and understand how to analyze and underwrite them. There's a call to action on top where it says register now. So please click on that so that way you can RSVP to save your spot for the event next month. We have a special guest speaker, Mr. Lee Johnson. He actually was one of our students about 7 years ago. He attended our rehabbing fix and flip boot camp, was able to get his first deal 30 days afterwards. He's been a loyal customer of the Washington Capitol when he's doing his fix and flips. All right. But now he's ventured off to do multifamily syndication and so many other things as well. He'll be our guest speaker to talk about multifamily, how that works, how you can do your value add plan from there, and what are the pros and cons of a long-term multifamily deal. Okay. Generally, those take about 3 to 5 years for them to go through the whole cycle of equity growth and also cash flow. So with that, guys, thank you very much for joining me tonight. We look forward to seeing you guys next month on September the 8th at 7 p.m. on this webinar. Thank you very much. And Connor from Washington Capitol, thank you very much for joining us. Take care, guys.
Thank you.